This is TreppWire Week in Review for the week ending December 1st, 2023. I'm Haley Keene with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Chief Product Officer. Investors got more good news this week as bond yields continued to plummet even as GDP was revised higher. Meanwhile, the Personal Consumption Expenditures Price Index, excluding food and energy prices, rose 0.2% for the month and 3.5% on a year-over-year basis. Between falling yields, benign inflation, and strong economics, Manus, are we in Goldilocks territory?
It certainly feels that way this week. We're going into the end of the year feeling pretty good about things, and we're going to unravel a lot of that this week. But I think you nailed the sentiment on the head. On the financing side of the ledger, bond yields, just another extraordinary decline this week, really across the spectrum. On the very, very short end, we're still looking at yields because Fed funds are so high in that 5.5% rate. But everything from the 2 to the 5 to the 10 to the 30 really tumbled this week. We're now probably 60 basis points lower in yield than we were 30 days ago on everything from the 5 to the 30. It's a terrific thing for those that are looking to refinance their debts. More and more properties, loans, financings, what have you, should pencil now compared to when the 10-year was at 5%. All of that, very positive. The PCE number that came out today, quite benign. As you mentioned, when you take out food and energy, inflation was 3.5%. I think people are still feeling the impact of that 9% last year, right? When you add 9 last year to 3 this year, you're up 12% over the last 18 months, which is meaningful, but we're heading in the right direction. And then when you look at the uptick in GDP, the fact that Q3 GDP was revised higher to 5.2%, I think everything just feels better than it did 3 months ago. And you can't deny, I don't think, the fact that there's a wealth effect out there that transcends just the consumer. For the consumer, when your 401k is higher, when stocks are going up, you're more inclined to take that family vacation. When you're seeing spreads contract, when you're seeing treasury yields go down, and you're seeing stock prices kind of hit year-over-year highs, as we've seen over the last month or two, I think that makes you as a lender, as somebody who's considering buying properties, more confident. All of that is helpful going into the new year. To be sure, we're not out of the woods. A lot can go wrong. We're going to talk about delinquency shortly. But for now, it feels like we're going into the end of the year with more momentum than at any other time during 2023.
Yeah, I would agree with you, Manus. And it feels like I actually saw several articles this last week where the sentiment around office has kind of hit a turning point, where there were some people talking about office with some small confidence or optimism around the office sector in certain markets. And that's something we haven't seen over the last couple of years. And so, to your point, I think maybe as much as people resisted Powell's higher for longer, and we're going to do what we have to do to tame inflation terminology at the front end of this cycle, this concept of a softer landing maybe is becoming a little bit more realistic for people in the marketplace. Just seeing the yields be as volatile as they are, but end the year, or at least this week where they are now, to your point, bodes well for the market at large. And the GDP number, again, I think it was surprising at 4.9 when they revised it up to 5.2. That's even more symbolism of the market strength. And so, maybe one thing to keep an eye on, and this is something that I know the Fed has talked about for some time, but we haven't seen a lot of movement, is unemployment. And so there was definitely an uptick. Unemployment claims surged to 1.93 million, which was an increase of 86,000, and is now at the highest level since it's been since November of 2021. So maybe there's something there, but I think that's one of the intended consequences of the rate hikes. So we'll see what happens, but I'm with you. I think we're entering the last month of the year really in a pretty good spot compared to where we probably all would have thought we were maybe 4 or 5, 6 weeks ago.
Yeah, it feels good, and it's happy to talk about it that way. And, before we get
lots of people emailing us, telling people that we're Pollyanna. Our optimism is measured, to be sure. We're going to talk about how the fact that office delinquencies ticked up again this month. We'll talk about that shortly. Nobody's popping corks on the lender side. Nobody's doing the kind of volume that they hoped to do at the beginning of the year or what they were doing in 2021 or early 2022. Certainly that's true of sales brokers. We're not seeing the velocity of money. So we don't want to make it seem like, we're all giving attaboys out there and popping corks. We're not at that territory, but we just feel a little bit better than we did 6 months ago. So that's the perspective we're coming for here on, I guess it's November 30th, the last day of November in 2023.
Magnus, we've also seen a decent amount of new securitizations this month. Is that part of the optimism that we're seeing?
I would say so. It does seem, I haven't crunched the numbers yet, but it does seem like November was our best month of new issuance in a while. We saw several conduit deals get priced. That's terrific. We saw several big single asset deals get done. Also terrific. The diversity of the types of assets that we saw shows that it's not just, for example, industrial leading the way. One of the single asset deals was Tyson's Corner, which is a big retail property. We did see a big industrial deal get done. That was terrific. I just want to run through a couple of the deals that we saw just to give people a sense of what I'm talking about. A new deal was brought by BMO recently. This thing hasn't been closed yet, but it's going through the marketing process right now. 3 of the 4 top loans in this deal are retail loans. And we all know that retail has had its lumps over the last 5 years. And there is a narrative out there that certain property types like retail and office are struggling to get financing. Yet in this conduit deal that is in the market right now, 3 of the 4 top loans are retail. And to give you a sense of where these things are getting financed, the top one, DSCR of 2%, LTV of 41. So very low leverage, the rate there, high 7s, but a deal is getting done. Financing is available. This is a mall in Hanover, Maryland. Another one in Schaumburg, Illinois, $55 million loan, 242 DSCR, 38 LTV. Again, very low leverage, but financing is available. The last one is a portfolio loan, 2.0x DSCR, 51 LTV. So there's a commonality here that financings are getting done. The underwriting is very, very conservative right now, but it runs in contrast to some of the headlines and narrative, which is there is no financing available.
Yeah, I would agree with you, Manus. And I went back and pulled up some stuff real quick just to look. It looks like from October to November, just on the conduit side, that there was 9 deals issued. We went from 46 and from January through October to 55 in November. So 9 deals at about $5 billion worth of total issuance. If you look at that same month over month, like September to October, there were only 3 deals issued. August to September, 3 deals issued. You have to go back to July. So from July to August, there was another month with 9 deals issued. So to your point, this is a really good sign compared to what we've seen over the remaining 12 months, or, we're 11 months into this year. There's only been 2 times, this month being one of them, where you've seen this type of issuance. And so I think definitely speaks to optimism. I would agree with you as well. Like, this is tempered by the fact that we understand there's some other challenges still in the marketplace, but it does go against the narrative that there's just no capital available and there are no deals getting done. Solid properties, low leverage, good underwriting. Those properties are still financeable, and it's good to see a nice uptick from October through November.
Yeah, I'm just looking at 2 of the other deals that are in the market or have recently priced. In another one of the deals, this is a 5-year deal where all of the collateral is 5-year in nature, 60-month term loans. The top loan in another deal is also retail, and it runs in the same vein as the other ones we talked about. This is a West Hartford, Connecticut property, 175 DSCR, 44 LTV. So if you're not somebody that needs a 60 LTV to make a loan pencil, or a 65 or a 70, if you can live in that 35 to 50 LTV and a 175 and up DSCR, people are going to be making loans available to you, right? Especially if you have a decent duration on your tenant base. There is financing out there. The one caveat, as I look through these things, the one downside is only a smattering of office. That remains certainly the Achilles heel of this market right now. There are some office loans in there, but they are very small in nature. They are not among the top 5 assets. Most of the ones I'm seeing here are 30 million in size or less. And they too are quite low leverage, 48, 49, another 49. So there is some capital out there for office, but it's much more challenging than what we're seeing for retail.
So sticking on the topic of CMBS, we just released today for our clients and gave a teaser on Twitter. Our latest delinquency data is in, and we saw a dip in the rate for the month, but actually an increase in the office delinquency rate. So Manus, why don't you break that down for our listeners?
So yes, a modest dip this month, 5 basis points lower than last month, but some noise as there was in October. For those that remember last month's podcast, there was a sizable jump in the overall rate, and it was driven by a really sizable delinquency, a $900 million delinquency in the industrial segment. What we had last month was an industrial loan reached its maturity date. The loan had extension options. The option was not exercised on a timely manner. This blew up the industrial delinquency rate, shot it above 2%, which was unprecedented over the last several years. We noted cautiously that we thought that that loan would cure once the administration of exercising that loan extension took place. Sure enough, that happened in November. So what we saw was a plunge in the delinquency rate for industrial back under 40 basis points, which means that industrial really sank, but everything else was modestly higher in aggregate, topped off by a big uptick again in office. So running through the numbers again, overall 5 basis points lower, the headline number 4.58%. When we look at the individual property types, the one that jumps out at you is office. It increased 33 basis points last month from 5.75 to 6.08%. The first time in several years that the office delinquency rate has been above 6%. Everything else pretty good other than lodging. Multifamily down 18 basis points, retail up 2 basis points. Retail remains the weakest performer, largely because of delinquent mall loans that have been in CMBS purgatory for a long time. The other weak spot this month, lodging, that segment up 45 basis points from 4.76% in October to 5.21% in November. But offices, that's where everybody is riveted right now, trying to figure out when the pain stops there.
Yeah, I think it doesn't come as a surprise. I mean, I was on record as saying I could see office delinquency being 10% by the end of the year. Luckily for the market, it doesn't seem like we're going to get there, but still 6.08% is higher than what anyone wants to see. So it'll be interesting to see, are we kind of hitting that inflection point where things start to come down, or is there still more pain to work through the system? What do you think about the lodging sector, Manus? I mean, is that something more systemic that we should be keeping an eye on, or is that maybe just some assets in certain markets that got a little bit of a post-COVID bump that now are starting to struggle again? What are your thoughts on that?
Well, I think we have two elements to that, one which you've covered in the past to some degree, and one which has been a perpetual sore spot. On the item that you've talked about before, some of the delinquency is loans reaching their balloon date and not being able to refinance. So we saw a couple of those this month. We saw a big San Francisco Hilton, I believe, that went to special servicing this month. That loan is slated to mature next month. These maturing loans in a market where capital is constrained, those will continue to push up delinquencies in office, in retail, and in hotel, no doubt. And then the perpetual Achilles heel
has been those markets that have just been soft for a long time. Chicago, New York, Portland, San Francisco. I don't think there's anything that we're looking at that is an inflection point. I don't think there's anything in the data that says we're seeing some real weakness in properties that rebounded after COVID, but are now seeing a leveling off or a dip in occupancy or a retrenchment in RevPAR. I don't think that's the case. That may come in 2024 should we hit a recession, but I don't think we're there at this point.
I agree with you. I don't see anything in the data. All of the RevPAR and everything, as you mentioned, across the brands looks really strong, but it is definitely something to keep an eye on. This sector is a little more volatile since it's a night-to-night business than some of the other sectors. And, I think with holiday travel, they'll probably see a bump coming up here. But I will say, like, the pricing for hotels has kind of gotten out of control, as well as just airfare travel costs and everything else associated with it. So hopefully this is just a blip on a few of those properties and not something more systemic.
We have a lot of office stories this week, so let's run through those.
I feel like I did a slightly better job this week organizing them into sub-segments. So maybe there won't be as much jumping around from type to type. So let me start with two subleasing stories. One, I guess, greenish, and one which is not green by any means. The first one comes to us from a publication called ArtNet. They reported that the auction house Sotheby's, which has an office in New York's Upper East Side at 1334 York Avenue, Sotheby's has subleased half of its property to Weill Cornell Medical Center. I was stunned, I have to say, by how much office space Sotheby's has. 500,000 square feet on the Upper East Side. They are going to lease half of that space to Cornell Medical. That particular property backs a single asset deal that was issued in 2020. So I would call that a green shoot. We continue to see strength in the health science space, both from lab space, big pharma taking over space, but also hospitals, doctors' offices, big hospital firms taking on more and more space. The other one, not so good. This is more in Lonnie's neck of the woods. Jess Harden of The Real Deal reports that Mr. Cooper, who is a lender in the residential space, is considering offering almost 200,000 square feet of space at its headquarters. The firm is located at 8950 Cypress Waters Boulevard in Coppell, Texas. Mr. Cooper, you might recall, announced in late October that they were subject to a cyber attack. There's been lawsuits around that. And of course, in addition, we know that lenders are not lending nearly as much as they were 2 years ago. So lenders and servicers have been cutting back. But here we have Mr. Cooper looking to sublease almost 200,000 square feet in that Texas market.
Yeah, so just so you know, man, it's in a way only Texans can do. We took the phonetics out of that word, and the town is called Coppell. And so Coppell is actually a pretty affluent market area there, nice little office sector, some high-end homes, good school district. And Mr. Cooper, unfortunately, as you mentioned, is facing some real trouble. It'll be interesting to see what happens. A pretty sizable sublease space available in that market, although that DFW office market has been pretty resilient on the sublease takedown. So as those properties have sublease availability come online, there's usually somebody willing to come take that space.
Going back to the healthcare section, I do want to bring out, the healthcare medical leasing part of it. I do want to bring up something which I saw in the Wall Street Journal today, which is something early for people to keep their eye on. The Wall Street Journal was reporting today that I think it was Cigna and Humana are talking about perhaps merging. And what we've seen with these mega mergers, I think it would be like an $80 billion merger if they would come together, is a lot of office space tends to be given back when these types of things take place. So something to keep your eye on over time, just an early heads up there. Okay, moving to our second segment. I want to talk about a couple of extensions here, which I would call these green shoots. Why would I call them green shoots? These are CMBS loans that the borrower had reached their maturity date. There's been some headlines this week. Several publications have talked about how more and more borrowers are giving back the keys, going deed in lieu, not looking to support the property. In this case, we had three TreppWire stories this week of offices where the borrowers had negotiated maturity extensions. The first one, a $25 million loan in the borough of Queens, New York. This is the Queens Tower loan. The property is 175,000 square feet. The majority of the space is occupied by New York City government agencies. The loan was slated to mature in June. The extension pushes the loan out for 1 year. It now matures in June of 2024. This particular loan makes up almost 10% of the collateral behind a 2013 CMBS 7 loan. Second one Monument Place. This is a 220,000 square foot office in Fairfax, Virginia. The borrower has requested and has negotiated for a second maturity extension. The maturity now pushed out to the spring of 2025. This particular debt is $32 million. It backs a 2015 CMBS loan. In this particular case, the real encouraging thing was that the most recent occupancy as of Q2 2023 was only 36%, yet the borrower still fought for an extension here. And in fact, they paid $500,000 into a CapEx account and another $500K into a rollover reserve account. So good news there. Lastly, in Philly, a $37 million 1 South Broad Street loan. The loan was slated to mature in December 2022. The new maturity date now is June of 2025. This is a 460,000 square foot office in Philadelphia. Wells Fargo was once the dominant tenant. It vacated. Occupancy dropped from 80% in 2020 to 57% in 2021. Since then, it's now down to 51%. Yet again, here, the borrower has leaned in and fought for an extension. So while that narrative of borrowers giving back the keys may persist and may be true, there are exceptions to the rule.
Yeah, so there's a lot to digest here, Manus. I had a couple of questions. So if we go back to the Queens Tower building, they get a 12-month extension here from June of 23 to June of 24. And as you mentioned, the property is about 90% occupied, and the majority of the tenants are government agencies. It has a super healthy DSCR, 1.89. Government occupant tenants needing an extension maturity. Do you think this one is one where they just don't want to try to refinance into a longer term deal at the current prevailing interest rates, and they're hoping that the property sees some reprieve in interest rates for refinancing? Like, if I were looking at this one, I would say this probably checks most of the boxes for refinance now. Good occupancy, good DSCR, stable government tenants that probably are not moving anytime soon. That one kind of jumped out at me.
Well, that's certainly a possibility. There's no doubt that any borrower that can pull that off, that can keep a loan with a low rate in place longer, that's a win, to be sure. The other side of the coin here is, what we've seen for as long as we've been watching the market, without exception, is these government tenants, I hate to say it, they don't really take a lease expiration date seriously, right? These things come up, they extend, they don't move out. And you read this all the time in watch lists and special servicer notes where the borrower says, we have agreement in principle, but then it takes 18 months to paper this thing. If I were to guess, I would say that they have leases, as I'm looking at this data, lots of it coming due in 26 and 27, where they just can't get the tenant there to either commit or to in any way move with any sense of urgency. And we see it all the time. And in that particular case, I think, it's probably part of the equation, although I'm sure they're happy to keep this rate in place, which is looking at it 4.2%.
Right.
Who would keep that in place? Who wouldn't keep that in place if they could?
Yeah, I think that's actually a good rationale as to why maybe like the government bureaucracy that comes with getting those leases renewed and so forth is a legitimate challenge timing wise. The other one that jumped out at me was the Fairfax building, where they put in $1 million worth of CapEx and rollover reserve when DSCR has been less than 1% since 2020. that's one of the ones where maybe you just shake your head a little bit. Occupancy at 30%, willing to put $1 million in, hopefully for the owner that's willing to pony up and do that. At least they got an extension on this one until 2025. So maybe the market has turned by the time it gets to maturity. But I think indicative here that the lenders really don't want these buildings back in today's market. And they're doing everything possible to try to get extensions, modifications, other types of remedies, even if it's kicking the can down the road 12 months or 24 months executed. And so I'm with you. The sending the keys back has not really played out in practice based on the stories that we cover each week.
Yeah, so I look at these guys that lean in, and I'm trying to find it on Google right now. I've referred to this in the past. There's that scene in It's a Wonderful Life where there's the run on the bank, and everybody's asking for $20, and George Bailey's sitting there giving out $20, watching his capital base erased. And there's that one woman who comes in and asks for $17.50. And it's such a moving scene. He reaches across and kisses her on the forehead because he's thinking, there's one woman who's not going to take $20, and maybe I'll live to fight another day. My capital won't be reached out. I feel that way with this Fairfax, Virginia borrower, putting in $500,000, leaning in, putting in a CapEx reserve. That borrower is the one that I want to reach across the aisle and kiss on the forehead and say, attaboy. There's a person leaning in and giving a sign of faith in the office market. And I love that. So, and I'm going to say some more. I have more signs of faith before this podcast is over.
And with that, Manus, let's talk about some more positive stories.
All right, Haley, you asked for it. You got it. These are of a similar nature. This first one comes from Real Estate Business Online. Harwood International is going forward with developing Harwood number 15. This will be a 340,000 square foot office in Uptown Dallas. I'm sure Lonnie knows this area much better than I do, and he can comment on it. Also in Texas, this comes from the Houston Business Journal's Jeff Jeffrey. Midway is moving forward with plans to build another portion of its city center mixed-use development in Houston. The company is going to devote $88 million to office space at 903 Town and Country Boulevard. That property will be called City Center 6. This will break ground early next year. The hoped-for completion date is in October 2025. So why do I bring these two stories up? I bring them up because in times of distress, in times of panic, you don't hear people putting money to work. Here, what you're saying is people are putting shovels in the ground, starting new projects, getting backhoes out, getting the cranes ready. I don't know if these things are on spec or not, but they are leaning in. Again, there's that word again, or two words again, that this doesn't happen in periods of abject panic. And we don't have abject panic. We have people greenlighting projects, even as conditions are choppy and unfavorable at times.
Yeah, these are great stories, and I think we need some new development topics like this that we can cover that are green shoots. So I'm glad that we have a couple. I'm glad that a couple of them come from Texas. The stuff there in Uptown Dallas, I've been there a few times, but I'm not quite pretty enough and don't make enough money to really peruse Uptown too frequently. But it's nice to see this is one of a couple of new construction projects that they have in that market, and it seems like that entire Harwood district, occupancy for that sector is sitting above 90%. So definitely a bright spot for the marketplace. That's definitely where a lot of the capital is flowing, and for good reason. There's good shopping and entertainment in that market as well. And then in Houston, really great news here to see. I mean, $90 million approximate, office tower being built is pretty, surprising, I guess, given all the negative headlines. And we've covered the Houston office market at length, Manus. It's one of the most interesting office markets in the U.S. because first, there's like 4 downtowns in Houston, and there's huge office complexes. Those things can trade for $50 a square foot in the downturn, and they can trade for $400 a square foot in the boom times. And we've had a little bit of both over the last couple of years. So it's nice to see a good sized project getting underway there with on-site parking and so forth. So 2 good green shoots for the office sector in Texas. I'm proud of those.
Yeah, it probably underscores the fact that these are new projects, the trend we've seen over the last year, which is tremendous demand, strong demand high rents for new developments. And I imagine these are going to be highly amenitized Class A properties. And these developers are counting on that, probably luring away tenants from the dated Class A elsewhere in Houston and Dallas, or the Class B or the Class C. You know, with every green shoot, there's probably some other fallout in terms of crabgrass that will impact a B or a C, but it is nice to report these. I'll close out the office segment with 3 more stories, all pretty good. This first one comes from Savannah Sicurella. We've referred to her many times before. She's from the Atlanta Business Chronicle. She reports that Trimont Real Estate Advisors has signed the largest office lease of 2023 in Buckhead. That's part of the Atlanta MSA. Trimont, which already has a big presence in that area, is leasing another 50,000 square feet at 2 Alliance Center. That's a 29-story tower in Buckhead. It can accommodate 200 employees. Trimont is a big servicer, and the fact that they are taking more space is a little bit contrary to the narrative. A lot of these servicers giving back space. Here they are taking more. In Colorado, this story comes from Scott Baltic of Commercial Property Executive. Excel Energy of Colorado has pre-leased 220,000 square feet at a new development called T3 Rhino, which is a new Class A property in Denver's River North Arts District. Property is owned by Ivanhoe, Cambridge, Hines, and McCaffrey. They're the co-developers. This property will open in 2025, and Excel will be the largest office tenant in that submarket. So tremendous development there. And lastly, in Arlington, Virginia, Rosslyn Gateway, which is a stalled project in Arlington, has been acquired by Penzance for $52 million. This was reported by the Washington Business Journal. The sales price for the 250K square foot office equates to $208 a square foot. JBG Smith was the seller. This site has long been targeted for redevelopment. As far back as 2012, JBG was looking to replace 2 towers there with a mixed-use property that will now turn over to Penzance to pull off. But again, a property here where Penzance sees opportunity in a market to redevelop in a time where financing is constrained and the risks are plentiful. So good for them.
Yeah, it is good to see some of those advantageous, opportunistic transactions taking the place where there's increased risk, but potentially significant upside. I did want to circle back, man, as you mentioned the Class A new construction projects being highly amenitized. So I wanted to ask a quick question on that Harwood number 15 story that we talked about there in Uptown Dallas. It says it's going to have spa-like amenities, including saunas, steam rooms, and a cold plunge. So are you more of a steam room, sauna, or a cold plunge guy?
I'm definitely more of a steam room guy, I have to say. You know, we used to have offices in New York on Madison Avenue. It was a Class B building, 477 Madison. We were about 10 blocks from Central Park. And one of the greatest things about our office was that we had a side room that had a dressing area, a big bathroom, and a spectacular shower. Hot water on demand with spectacular water pressure. And it used to be my pastime to throw on some shorts, go into Central Park, do a quick 3-mile jog, and then come back and just completely enjoy a spectacular high pressure instant hot water shower at my Madison Avenue Class B office.
That sounds like fun. I actually have an interesting story one time where a friend and myself decided we were going to ride our bikes to work. It was about a 5-mile bike ride. And it was because our office had a shower that not a lot of people knew about, but we were convinced we were going to ride our bikes, be able to take a shower and get ready for work. So we did that one morning. This is in Texas, mind you, not very friendly to bike riders. We got spit on, almost run over about 12 times. We finally make it to the office. I go in there to take a shower. They remove the hot water heater. No hot water. Not great water pressure. in a nasty old shower with freezing cold water. So the bike ride to work project lasted 1 day and probably goes down as a pretty big failure on my part.
We'll keep that only in New York then, not the Dallas office. All right. Last week we talked a lot about retail earnings, and we have some more retail stories to cover this week as well.
Yes, we're still trying to get our arms around the Black Friday holiday sales. We'll talk more about that next week. Early indications are that online has been quite good, really spectacular, which I suppose is a bit of a green shoot. It just goes to show that the consumer isn't completely tapped out, but it does seem to be coming slightly at the expense of brick and mortar. It seems like brick and mortar has been meh so far from what the early indications are. We'll have more on that next week. We have a little bit of a potpourri retail stories that we'll go through. And of course, we did talk about some retail financings at the top and where people are getting financings and what kind of DSCR and LTVs they need. The first one we'll talk about is a sale. This was reported in our new offering, comes out every morning at 7:30. It is tied to our podcast. I think we have several hundred readers or listeners of our podcast that have taken up on opting in and are now getting our 7:30 a.m. insights. So thank you for those that have joined. This first one, a sale in Westlake, Ohio. Carter Properties paid $42 million or $284 a square foot for West Bay Plaza. The seller was Site Centers. The buyer, as I said, Carter Properties. This is a 150,000 square foot retail property that counts Fresh Time Market, HomeSense, Sierra Trading, and Ulta Beauty as their tenants. Tenants have a weighted average remaining lease term of 7.3 years. The property is on Detroit Road in Westlake. On the financing side, we talked about that Tyson's Corner shopping mall deal. Here are some of the terms for this. The debt size, $710 million. It paid off a $667 million loan that was set to mature in January. The new loan terms are as follows: 5-year term. The lenders were Deutsche Bank, Goldman Sachs, Bank of Montreal, and JP Morgan. The coupon is 6.85%. I believe it's floating rate. The new loan was CMBS in nature. It backs a SASB deal, and the property itself is in Tyson's Corner. The previous loan was made by Northwestern, PGIM, and TIAA. So a little bit of the financing that was there.
Yeah, so Manus, that's a nice story there. Just to give a few other data points on that loan, it was 4.1% coupon, amortizing on a 30-year schedule. Almost 2 million square foot. And I think, this has got to be considered among the country's top performing malls. Inline stores, so these are typically stores with less than 10,000 square feet. We're on track to generate about $1,200 a square foot in sales for the year. So this is a really nice story. This would have been a great one for us to talk through with Carmen Spinoso to kind of see where those inline sales numbers compare to maybe what he's seen across the U.S. and other similar type of mall situations.
Yeah, in terms of the financials, and by the way, that sales per square foot is just extraordinary. A lot of the mall financings we've seen over the last 10 years, $400 a square foot, $450, $550, $1,200 a square foot is just through the roof. But in terms of the financing, LTV just under 40, securitization debt service coverage ratio about 2.0x. So it goes hand in hand with the notion of all of these loans being very low levered, right? We're not seeing 60s, 65, 70s in the mall space these days, but it is just another green shoot. And there's been plenty of them this month that there's this much debt being put out on a shopping mall. In this case, it's in McLean, Virginia. I'll go through a couple of other retail stories very quickly. We put out one in TreppWire this week, a pair of, I don't know if I'm pronouncing this right, Architera portfolio loans are now with special servicing. Earlier this year, Architera Companies was sued for misusing investor cash. Bloomberg broke that story. Now 2 of their portfolio loans have shown up as either with a special servicer or as 30 days delinquent. That's as of November remittance data. One of them backs a 2020 CMBS 14 loan, which totals about 58 million. That loan is backed by 14 retail properties across 9 states. The portfolio totals about 650,000 square feet. The other one backs a 2014 CMBS loan. The loan there, 16 million. That particular asset backed by 12 retail properties spread across 8 states. Why do I bring this kind of story up? It's just a reminder that stories often are broken long before distress pops up. In this case, Bloomberg, to their credit, broke the story that the sponsor behind these loans was accused of wrongdoing. 6 months later, now these loans are delinquent and with a special servicer. Next week, we're going to talk about in TreppWire 2 properties that are now on watch list, but we broke 2 years ago and 3 years ago as having lost their top tenants, but only now are they going into watch list. And it's just a reminder that if you're in this space, it always has to be a head on a swivel. The news comes out every day. Often the news comes out 6 months or a year before the distress takes place. And that's why I wanted to bring up that story. And then I'll bring up a last story, tongue in cheek. New Yorkers will know this well. If you've walked down 6th Avenue, 7th Avenue, through Times Square or up 5th Avenue or Madison Avenue, there's always those stores selling tchotchkes. New York City T-shirts like the one John Lennon wore in that iconic photo. New York baseball hats. For some reason, they're selling luggage. They sell Statue of Liberty tchotchkes. And you always scratch your head and say, what in God's name is that store doing at that location? How is that not being used in a more productive way? And ironically, a lot of them have the sign going out of business in 30 days. They've been going out of business for 15 years. Well, this week we wrote a story. There's one near Penn Station in Times Square. The property itself is a 25,000 square foot retail property near Macy's in Midtown. Half of the property, I think, is a phone thing, like a Sprint store. The other half is one of those stores that sells T-shirts and baseball hats. And it does indeed look like they are closing. It's not just the sign out in the front. It's look like they will lose that. The landlord will lose that. And as a result, the property at 136, 138 West 34th Street near Macy's has gone on watch list, backs a $30 million CMBS loan that backs a 2014 CMBS deal. So if you're looking for tchotchkes to stick in the Secret Santa pile or maybe in the Christmas stocking, now's your time.
So is this where like they put 2 going out of business signs, like the first one that's always there for 20 years and the one below it's like, really, we mean it this time? You know, is that they got to file a permit to get like an extra going out of business sign?
It is just such a funny thing.
So we have a few hotel stories, some of the sales we've been tracking in some of our new daily content.
Yeah, so we're going to talk through a couple of these transactions. Again, if you're a subscriber to our daily content, this will be something that you would see. The Embassy Suites Hilton, South Jordan, Salt Lake City. That's a lot. So Embassy Suites by Hilton, South Jordan, Salt Lake City was acquired by Apple Hospitality REIT for just about $37 million. That's according to Hotel Business. That translates to about $191,000 per key for the hotel, which is comprised of about 192 rooms. This isn't the first deal for Apple Hospitality in the Salt Lake City market. They also acquired a 175-room Courtyard by Marriott, Salt Lake City downtown, for about $275,000 a key back in October, and a 159-room Hyatt House, Salt Lake City downtown, for about $215,000 a key. So we'll see if they're more active now that they've acquired, multiple properties, or if they feel like they've gotten the market share they're looking for in that marketplace. One other story here in St. Petersburg, Florida, Holiday Inn sold for $18.75 million. This was acquired by Next Gen Hotels for about $146,000 a key. It's a 129-room Holiday Inn St. Petersburg West Hotel. And NextGen is a Chicago area investor that purchased the property from smaller owner-operator out of Mobile, Alabama. That's according to county records. Previous transaction on this property was in 2021, coming out of COVID for about 11.8 million. And so in this instance, they profited pretty significantly in a pretty short period of time. This hotel has an outdoor swimming pool, fitness center, and some meeting space, just 10 minutes from downtown St. Petersburg. So two pretty good stories in terms of hotel transactions, with the first one actually being a little bit of a piggyback story on the fact that they had purchased some other hotels there in Salt Lake in October.
Yeah, the hotel sweet spot right now seems to be in that 25 million and below. When you look at the auction houses like the 10X and the Real Insight marketplaces, those are loaded. I would say 60 or 70% of what they offer during every auction appears to be hotels of modest price, 15 million and below. And whenever we see these hotels, we don't see too many in that 50 million and up, and certainly not too many in 100 million and up, but we do see a lot, I would say, every month in that 30 million and under. There's just a lot of demand in that space. And I think a lot fall into that category, Lonnie, of what you just talked about, things that sold for X 2 or 3 years ago and now are selling for 1.4, 1.5, 1.6X a couple of years later, which underscores the strength of the hotel market, the amount of rebound we've seen outside of a couple of soft markets, and it's nice to see.
It's really great to see just the folks that were brave enough to purchase hotels when it was the great unknown coming out of COVID. A lot of those bets have paid off really handsomely for them. So, we talked about some of the office redevelopment transactions and some of the other office sales this week. Hopefully for those folks that are brave enough to make a move today, not knowing what office looks like or maybe what the redevelopment costs truly are, I'm hopeful that they can see similar type of uptick in their profits as well.
So a quick programming note before our shout outs. We've been plugging for a few weeks now a series of reports that we put out on criticized loans in the bank universe using our anonymized bank data. We released another edition this week on the retail segment, and I know a lot of you guys have been interested in that, so reach out to us if you want to see the latest. And speaking of our bank data, we will have a webinar on December 7th at 11 a.m. Eastern, diving into trends in the banking world and what we're seeing in terms of delinquencies, originations, and more. So reach out to us if you want that link. And then for shout outs, we had Ali F reach out, who really enjoys the podcast and was interested in some of that taller data. Anthony C from Kentucky thanked us for such a great podcast. He said he's been getting up to speed on real estate over the past couple of years and has found it very insightful. I think he had a question on some BBB CMBS, so we'll get back to you on that. Riley N reached out in relation to a few of the topics that we talked about over the past few weeks. He said, each week we continue to solidify ourselves as the best pod out there. So thank you, Riley. And we appreciate the feedback. On Apple Podcasts, we had a review from Bloodhound99 who said, the TreppWire hosts have the Midas touch, juggling Siri data stuff from DSCR to cap rates. So much to learn from these guys. So good job, Lonnie and Menace. Max C reached out to us. He said his team is a huge fan of all things Trepp, especially the podcast. And I think they requested maybe 8 to 10 t-shirts. So we might have to make a trip down to your office, Max, or you guys might have to take a field trip to ours. We can meet you and get you some t-shirts. Minaj R is a big fan of our podcast and was interested in our sales-based analysis and some of our CRE CLO data. Soren is a regular listener and loves the pod. Paul H. from London met with our colleague Vivek at a European CMBS conference this week. And one of the first things he mentioned was that he loved the podcast. So thank you, Paul. Jake S., this was a fun one. So this week we had our Spotify Wrapped come out. So if any of you guys listen or are listening right now on Spotify, you can actually get a roundup of all your top music and top podcasts from the year. So we had a few people send us their top podcast, which was ours, which was really great to see. So Jake S. said, greatly enjoys the podcast, and he got confirmation via Spotify that he is indeed a Trepp head.
There we go. You know, my girls were getting, and my wife too, were getting these personalized messages yesterday from Taylor Swift that apparently if you were in her top 10% of listeners last year in Spotify, a personal message from her popped up with her thanking you in video form for your active listening of her songs and so forth. And I just thought it would be tremendous if we can have Lonnie do the same thing. Like, can you imagine you're sitting there like, you know, just hanging out, you know, have your pods on, you're riding the train home, and then bam, there's Lonnie showing up on your podcast, giving you like a personalized, hey, Matt C. from Spokane, Washington. This is Lonnie here. I just wanted to thank you from the bottom of my heart for all the time you spent on our podcast. You know, Haley, can we make that happen? Do we have the technology to do that?
We might be able to send it on Twitter. So tweet at us if you have us in your top Spotify. We'll see
Yeah,
if we get Lonnie to make some
if we get a
videos.
few folks to respond, I might be willing to do a little cameo work. And Haley and I were on a meeting earlier today, man. It's where we're actually talking about having something similar to that for a pretty big announcement that we're going to be making next week in some of our products. And so last year at this time, we were talking about Lonnie on the Ledge. I don't think I'm anywhere near Taylor Swift, but yeah, we'll see what we can do. Maybe I can do some pop-up thank you shout outs on the little Twitter sphere.
We also had Tom D, 50 Burgers, and Nat on Twitter send us their screenshots of us in their top pod. So thank you all for that. And then we had some last shout outs to Ben P, Josh N, and Inrahim, who loved our podcast with Shlomo Shop or with Carmen Spinoza. So if you haven't listened to those two guest pods, we were very busy around the Thanksgiving holiday. I think we had 4 podcasts in a 1-week span, but make sure you catch up on those guest pods and send us your feedback.
I'm going to have to get Lonnie some lozenges. He's been doing so many of these podcasts with us. You know, he's got to be talked out just like I am.
It was interesting because Haley, you sent us around something last night that talked about how many minutes we had recorded on the pod or whatever, and it was pretty remarkable. And I know Manis and I do a lot of other speaking engagements and other things, and so yeah, if you actually think about how much time we talk about CRE in a given year, it's pretty remarkable.
And that's not just in your business life. We hear it's in your personal lives too. So,
unfortunately, yes.
Well, thank you to all for listening, and we will see you next week. So with that, we'll close. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or just a comment, send an email to podcast@trepp.com and subscribe to the TreppWire Podcast with your favorite provider. Thank you for listening and stay well.
All right.